Good afternoon, everybody. Welcome to Tech Talk here at MarketStream.live. My name is Joseph Cusick with the Cusick Group, securities offered by MoneyBlock. This is where we're going to break down a couple stocks that are going to have earnings this week. I want to focus on JP Chase and Wells Fargo. Ticker symbols are JPM and WFC. Now, before I go into the actual underlyings, I want to lay out two things. One is that we're looking at charts. That's just to give us a picture of what's been going on. And I like to start with looking at a picture of the whole market and specifically the financial sector. For you stock traders, this is going to mean a ton to you because this is basically how you look at the marketplace for the most part, along with the fundamentals like earnings, and which are coming up on Thursday, and that's going to be pre-market. Financials are also a component of the market that needs to start moving to the upside if, in fact, the bulls holistically or in general, looking at the S&Ps, the NASDAQ, as well as the Russell 2000 and Dow Jones, they're going to need to lead the way. And so looking at finance right now, we can see that XLF is trading down 3 cents, basically down 0.1% today at 23.49. You can see that it's clearly been in a very tight consolidated range, but one thing that I want you to notice, that red line and green line, that's the 20 and 50-day moving average. The 20-day is the green line, the red line is the 50-day moving average. That is clearly resistance right now. The bulls have been on their heels in finance, and it makes sense. As a matter of fact, if you look at this part of the screen, you're going to see the bonds. The bonds have been going to the upside for the last couple of weeks. They've consolidated slightly, but the bonds are in the green. This price action right here means that the bond prices, the price to buy these bonds, have been going up. That means the yields on those bonds have been going down. That is not a positive for finance. Now, we have quite a bit of information that's going to be coming out economically, as well as the fact that we still have the geopolitical headlines that are coming through out of Syria, out of Europe, and out of China and Korea. And so there's a plethora of different types of risks in this market. But just looking at how this consolidation has been in finance, there needs to be some momentum to the upside. What can drive finance to the upside? If the bulls are going to take control, that's going to be earnings. So let's take a look first at JP Chase. And the reason why I look at charts is because I need to get a picture. I need to understand what's been going on with Chase. And you can clearly see right now that the market's been down and then a consolidation. Once it's broke its 20 and 50-day moving averages, that's where the sentiment or tone of the stock changed. It became bearish to neutral at that stage. And until it can take back that 20 or 50-day moving average, I'm going to continue to have that stance, with $76, that black line right here, being the point where you're going to see long-term support come into play. Taking a look at the option space, and if you go down and take a look at the weekly options that are going to be expiring on Thursday, because we do have a shortened holiday week, this couldn't be more of a perfect time. The stock is trading at 85.84, so it's down 33 cents today. You basically take a look at the either 86 calls and puts or the 85. That's your prerogative. I'll look at the 86. Basically, you can do one quick straddle. That's the same strike call and put for this expiration cycle. And then the first strike out of the money put, first strike out of the money call. Now, for you stock traders, you're going, great. Here it goes, the options guy talking math. All I'm doing is showing that you can use these option prices to forecast what could be a potential move or range in the stock. Right now, if you add up all four of these offers, right, this is the ask price, you're basically looking at probably about 375, which almost, about 370. That's basically giving you about a $1.70 move. You divide this total up by 2. This is giving you a $1.70 move going into the expiration of these options and into earnings on Thursday morning. That means that the options are pricing in a 2% range, either up or down. This range that I'm giving you is not exuding bullishness or bearishness. I'm just giving you the pure math behind what the options are pricing in for potential movement in the stock. You ain't hearing this on any other media network. Also, the implied volatility rank, that is my barometer of whether I should expect big violent moves. The closer it gets to 50, 60, 70, 80, 100, that means that there's the high potential of a violent move. If it stays below 40, 30, 20, 10, there's not a heightened sense that there's going to be a big violent move. Right now, JPM is at 35 as far as implied volatility rank. So I'm a little bit more conscious, or going to be a little bit more tepid, especially if I'm going to be putting on a new position, whether I'm bullish, bearish, or neutral, in JPM in advance of this particular underlying of this earnings announcement. If I currently have a position on, that means that I'm going to look at it very closely and see strategically. If I'm long stock, do I take advantage of the volatility that is in the options and maybe sell an option, specifically a call against my stock? Do I, if I am bearish, look to maybe put on an in-the-money bull bear put spread? If I'm bullish, do I put an in-the-money bull call spread on? Do I collar it off, sell a call and buy a put on stock that I own, especially if I have 100 shares? You're seeing now what the options are, no pun intended, for JPM and the expectation of what potential movement is. Right now, if you looked at the out-of-the-money strangle right now, if I remove these, and what I mean by that is, I'm just going to remove these. That's the first strike out of the money call and the first strike out of the money put, a one standard deviation move, which basically gets you into the $89 strike to the upside, which isn't even represented here right now. I'm actually going to put more strikes. There's only basically a 28% probability that it's going to get above 89 or below 83. Actually, it's less than that. It's about 20% probability of being above or below those levels going into Thursday's expiration and the announcement of the earnings. If you were to sell these one standard deviation out of the money options, in other words, the 89 calls and the 83 puts, you would collect 28 cents. But and there's only a 77% probability of that actually working against you at this juncture. And there's only really, it's a very small amount of money for the amount of risk. So you can see that they're not pricing in a huge move, right around 2% in JPM going into earnings, but it's something that we have to watch, especially with the current environment that we're in. Want to look at Wells Fargo, because not only is Wells Fargo announcing earnings, but they also came out with their findings on the sales practices that were somewhat predatory, as well as under scrutiny, rightfully so. Bottom line is Wells Fargo, similar to JPM, in March has pulled back considerably. Pierced through its 20-day and its 50-day moving averages. The bears took over, but it's been consolidating, and in the last few sessions has been looking a little weaker. Now, the headlines about the fact that they're pulling back and clawing back bonuses from the executives that were supposed to be supervising during this period where they had sales practices that were deemed aggressive, to say the least. The bottom line is that the stock right now is at a critical juncture where if it tips the scales below 54.55, we could see some movement. Now, you could take those words for what they're worth, look at the headlines and see that there's some negative stuff out there, but what actually is being priced in as far as potential movement? Well, that's where you go in, and this is where both stock traders and option traders need to look at what the estimated move. What is the option pricing telling us that the stock could potentially move? And if I look at the weekly options that are expiring at the end of this week, I can clearly see with the stock trading at 34.29, I'll go into the 34 calls, 34 puts, the 33.5 puts, and the 34.5 calls. I add up all the offers on this, right? And as a matter of fact, you could, for those of you that do not like math, you just have to put in the number of contracts that you want to do, and it'll add it up for you. So let's just say that it's basically right around, let's say $1.90. Okay, so $1.90 divided by 2, you're basically looking at roughly around a $95 move being priced in between now and Thursday. Okay. With that being said, that's basically a 1.8% range that's being priced in either up or down in this stock. And why am I looking at Whole Foods? I have no idea. I wanted to look at WFC, which, by the way, funny thing is that it is a $54 stock too. So the math is going to, believe it or not, is going to be relatively close. So again, I'm going to look at the at the money strike. So that's 54.64. So that's going to be 54.50. So I buy, same call, first strike out of the money put, same call, first strike out of the money call. I just put one lot in just because I want the system to do the math for me. Basically about 190 is the midpoint. Divide that by 2, that's where you're getting basically your 95 cents, right? And this is very efficient, right? It's very efficient that now I'm seeing that the options are pricing in between now and Thursday that the stock could potentially be in a range of about 1.8%, or in other words, 98 cents either up or down. This gives you context now, folks, into what the potential movement is going into the earnings, so that if you're a stockholder, you can kind of start channeling with some of those emotions that you normally would feel. Wow, a 98-cent move in basically 3 to 4 days. That might be significant to you. So then you could look at different strategic approaches. Go back and watch a couple videos. Look at doing a covered right. Look at if you're someone that cost averages in your position, instead of just buying stock after the pullback, take advantage of the implied volatility, which, by the way, is being ranked at 46%. So there's a little bit more of a heightened expectation of a potential violent move now that we're getting closer to 50% going into the earnings announcement. This is where, instead of layering in stock bids, you go in and sell maybe the $50 puts, which is an area where you'll collect premium. And again, I have a web strategy now show that I did on laddering in short puts. But for you stock buyers and you like to cost average down, selling puts could be very prudent to do. So again, take advantage of all this information, of looking not only at what's going on with the charts, understanding support and resistance from past price history, but take advantage of learning how we look at the market and use option pricing that's forward-looking. It has that implied factor into it, or component into the pricing, that is giving you a forward prognostication of where the stock could potentially move between now and the expiration of the options that you're using to make that assessment of estimated move. It's a great idea, right? Well, let's do it. All right, we'll see you at, let's say, 4:30 Eastern time. We'll do the closing bell. Thanks for joining us here at Tech Talk on MarketStream.live.